We're very, very fortunate to have Randy as a distinguished professor in the Huntsman School. He is, as you know, the Charles Koch Professor of Political Economy, and it may be that I played a small role in bringing him over, but I think it's much more the sense of excellence that our faculty and you, the students, are contributing to that brought Randy over here. So we're glad, Randy, to have you here at this point in your career, and grateful for the many contributions that you're making. I do have a few words to say in welcoming Dr. Kerry back to us today, and also to you, by way of introduction to you. I think many of you have received the little flyer with his bio that was passed out as we came in, so I'm not going to repeat all of those things. I would like to say just a word or two about John Huntsman and the Huntsman Presidential Visiting Chair that has been established that enables us to bring such extraordinary individuals as Dr. Back to us for short periods during the course of the semester. This year, Dr. Back has visited us twice, once in the fall and now here in the spring, and he's just concluded a 5-day, very intensive graduate level seminar with 9 of our most outstanding students. I encourage those of you who are thinking about perhaps majoring in finance and economics, and maybe someday continuing on to get a master's degree in our financial economics or our economics program, to consider these wonderful resources that we have who come to us by virtue of the gift of John Huntsman. You know, when I was a student sitting in these same seats as you were, we had several outstanding faculty that came to us as well. I don't know, Randy, if you remember Wolfram Honreiter from the University of Chicago, which I did as well when he was here. And these are tremendous resources that I encourage you all to be very much aware of, so when the time comes, you might take advantage of it. John Huntsman needs no introduction to this group, but I will say just one thing about his interest in establishing the Huntsman Chair in economics and finance. It was specifically so that we could receive the benefit of truly world-class thought leaders and researchers and teachers in this area. And Dr. Back is the 5th in our series of visiting chairs. He is the J. Howard Creekmore Professor of Finance at Rice University's Jones Graduate School of Business. He's previously been a member of the faculty at such outstanding universities as Northwestern, Indiana, Washington University of St. Louis, Texas A&M, and was a visiting faculty member at Wharton. We've asked him specifically to address his remarks to an audience of students, and we have some members of the community who've joined us, I note, who are beginning to look at economics and finance perhaps for the first time. And so without further ado, Dr. Back, thank you so much.
Thank you. I want to thank the university for hosting me here this past week, and Mr. Huntsman for his generosity that's made it possible. And I look forward to talking to you for the next 45 minutes or so. This is an unusual opportunity for me. Usually I teach a course, and I've got a course description, and I'm supposed to teach about things related to the course description, at least somewhat related to the course description. Or I'm talking about my research or discussing someone else's research. But I was given the opportunity today to just talk about whatever I wanted, understanding that the audience was largely principles of economics students. So I thought I'd talk about some things that I've always found interesting in economics. They underlie my research. I'm not going to talk very much about my research. I gave a seminar to the faculty here on Wednesday about my current research. But I will touch on a little bit of my research at the very end of my remarks. So I'm going to talk about some things that I find interesting. In fact, we're going to kind of hop around from one topic to another. We'll spend a couple of minutes talking about high-frequency trading along the way, something that's been in the news a lot recently. And as I said, I'll end up with just a little bit of my own research. What I'm going to talk about mostly are concepts that were recognized in 2001 by the Nobel Committee, who gave the Nobel Prize in Economics to George Akerlof, Michael Spence, and Joseph Stiglitz. I have some more people that your dean took classes on, I found out at lunch. For their analyses of markets in which different participants have different information, and how the differences in information across participants affect those markets. These are the key papers, so you get some idea of the concepts from the titles of the papers. Of course, all three of these gentlemen wrote a lot of papers during their careers, but these were the seminal, probably the most cited papers of each of them. Akerlof wrote about the market for lemons. Of course, a car is an example. A car that's been poorly manufactured is called a lemon. Spence wrote about signaling, and Stiglitz about adverse selection and contracting. So adverse selection and signaling are closely related, and I'll explain what each of those concepts mean. But I'm going to focus mostly on adverse selection, as the title of my remarks indicates. So this is a definition of adverse selection. Someone offers to trade with you, or offers a contract, offers the contract at large to the marketplace. They should consider who will accept that trade or that contract. And in general, the people who will accept it are those for which it's least advantageous to the offering party. When there are differences of information, the contract is likely to be accepted by those who have information unfavorable to the offering party. Now, that's a kind of abstract definition. We'll make it concrete with some examples in just a moment. Understanding this sort of selection takes place, the party offering the trade or contract should price it accordingly. So let me give you an example. You propose to buy someone's car. Naturally, she knows more about the car than you do. You know the car might be good or it might be a lemon. Okay. So what selection will you experience when you offer a price for the car? Who's likely to accept that price? You can chime in anytime. Ask questions, make comments, raise your hands. We'll treat this like a class. Let me make it really concrete. Some cars are good and worth $15,000, and some are bad and worth $5,000. So what price should you be willing to offer for the used car? $10,000 is the average price. And so that's a very natural guess. Thank you for proposing that. $10,000 is the expected value of the car that you're buying. Well, what will happen if you offer $10,000 for the car? What will the selection be? Who will take that trade? The person with a car worth $15,000? Only the person with the lemon, right? You're going to get lemons. So what price can you offer for a car that's reasonable? $5,000 is the most you can offer. And that means the person with a $15,000 car who might want to sell it is just out of the market, unless they're willing to sell it at a huge discount to its value. This explains roughly the disparity. It's not as huge as it used to be, but the disparity between used car prices and new car prices. You know, you drive a car off the lot, it immediately depreciates because the people who bring them back to trade them in are typically the ones with lemons. In auction context, this selection phenomenon, I'm going to give several more examples, and then we'll go to financial markets. I'm a finance professor. We'll discuss adverse selection in financial markets. In auction settings, this adverse selection is called a winner's curse. Okay? So suppose you run some sort of business and you bid competitively for jobs. For example, you build bridges, so you have to submit your bid for what price you'll build the bridge. And you estimate your cost. Everybody who's bidding against you is also estimating their cost. Their costs are pretty similar to yours, but everybody has to estimate. No one knows for sure. So what you do is you estimate your cost and you gross it up so you'll earn some margin, some profit. So you bid 10% over the estimated cost. Will you experience 10% average profits? What's the selection that you'll experience? When will you win in these competitive bidding situations? Everyone's estimating costs, and the costs are pretty much the same for everybody. So which auctions, which bids do you expect to win? What's the selection? Well, yeah, if you're a low-cost provider in the sense that you're willing to accept a lower profit than everyone else, then you'll tend to win on average. But let's simplify and say that everybody wants 10% profit. So everybody's going through the same exercise. Your estimate of your cost is just an estimate, right? You don't really know what the cost is going to be. Sometimes you estimate low, sometimes you estimate high. Do you win these auctions when you estimate high? When your estimate exceeds the actual cost? When your error is on the high side, do you tend to win? You tend to win in these sort of situations when your error is on the low side, right? When your estimate is below the cost that you'll actually experience. In fact, when you win this auction, what's the first thing you think? When you win this bid, what's the first thing you think? You're happy, but what do you know now? And what does that mean everyone else thinks the costs are going to be? Right. So you've made a mistake. That's what you know. That you've made a mistake when you estimated costs. Now, you don't want to lose money, so how do you bid in these situations? You know that when you win, it's a curse. Okay? It's a bad thing in that you underestimated the cost. So what do you do to avoid losing money in your business? How do you bid? Do you estimate your costs and bid 10% over? No, you take into account the adverse selection that you win when you've estimated low. And you've got to add some margin for that. Exactly how is a complicated problem, but you've got to add some margin to compensate for that winner's curse. Let me give you one more example, and then we'll discuss financial markets. Now, I don't want to make an argument for the Affordable Health Care Act or get deeply into all the many issues involved in that. But this adverse selection principle is important in that context as well. Why do people have group health insurance? Well, one reason is taxes. The government made a mistake a long time ago and considered health benefits non-taxable income, and that's distorted resources towards health care. But even absent the tax issue, why would we have group health insurance instead of private contracts?
Spread risk.
Spread risks? Because the insurance agency might not get enough people to sign up?
It's more along the lines that I might go in and have a really expensive surgery, but I'm surrounded by 9 people who won't. So if we spread that around, then we all bear that.
Right. So diversification on the part of the insurance company is a reason for writing a lot of contracts. You want to have a lot of policies written. But we could have, and that's an important point, but we could have private markets and still write a lot of policies, still have diversification on the part of the insurance company. Well, let me give you a concrete example. So we have 3 people with different expected health care costs, but the insurer can't determine who's who. They know more about their health than the insurance company does. So a company could offer a policy with a premium of $10,000 and break even on average, right? Yes, no? If a company offers a policy with a premium of $10,000, which of these 3 people is most likely to take it? The company will experience adverse selection. The people for which the policy is most attractive will be those for which the insurance company least wants to write it. $10,000 will only get you the 2 high-cost individuals. You could offer a policy at $12,500. Then you'll only get the $15,000. It's very much like the market for used cars. private health insurance market won't work absent a government mandate because policies will be exorbitantly expensive because the insurance company understands adverse selection. That's a rationale for a government mandate to make sure that that adverse selection doesn't occur, that there's uniform selection instead of adverse selection. Now let me talk about financial markets. I'm going to tell you a little bit about financial markets. We're going to discuss adverse selection in the context of financial markets. And I'll spend a minute or two even talking about high-frequency trading. So trading today is done on a computer, right? Everything goes through computers. People, you've probably seen, some of you have seen Trading Places, the movie Trading Places, the old Eddie Murphy movie. Students are getting younger and younger every year. Not all seen it anymore. There's not much going on in the pits these days. Everything goes through computers. Exchange keeps a book of limit orders, and I'll show you an example of a book in a moment. And when a market orders in order to buy or sell at market, it executes against the book at whatever the market price is. So limit orders have prices attached to them. Market orders just say, I want to trade it at market price, whatever that is. Here's an example of a book. This market's at $49.96 bid, $49.97 ask. So over here we have orders to buy. Someone said they want to buy 1,000 shares at $49.96. Somebody wants to buy 500 shares at $49.95. They may be able to do that later, depending upon market action. Other people want to sell, and they've announced prices at which they want to sell. Okay. So this is an example. There are many exchanges now in the U.S., and they all keep their own books, but this is an example of a limit order book. Suppose a market buy order for 1,500 shares arrives. To explain how a book works, let's do an example. So we have a market order for 1,500 shares. So what would happen? Someone wants to buy 1,500 shares in this market, and they're willing to buy it at the market price. What is the market price at which they would buy? Market order executes against the best available price. Someone wants to buy. Okay? So they have to trade, they have to match with someone who wants to sell, right? And so they're going to have to match with these orders to sell. So when the 1,500 share buy order comes in, it executes 500 shares against this order at this price. And the next 1,000, we call it walking up the book, the next 1,000 shares walks up the book and executes at the next best offer price. Okay? These are called bid prices. These are offer prices. So as I said, it would execute 500 shares would trade at $49.97 and another 1,000 trade at $49.99. Limit orders face adverse selection. Some investors will know more about the security than the people who make the market, the dealers in the security. So under what circumstances is an order to buy most likely to execute? When there's what sort of information out there that the dealer doesn't know? Good news or bad news? When is this order most likely to execute? When people have good news or bad news? Bad news, right? When people are selling, sell orders will execute against these buys and work down the book. What if people have good news and instead buy orders come in? Buy orders come into the market, like in our previous example. Buy orders come in, execute against these, the market price rises. If buy orders come in, this may not execute at all. The market may move away. The price may rise. And then you're going to have to reprice this order if you really want to buy shares, right? So you're most likely to execute when there's unfavorable news. But again, you experience adverse selection. So let me give you a simple little model, a simple model, maybe a simplification of a model of how security prices, bid and ask prices, are determined. This is called the bid price, $49.96. $49.97 is called the ask. Those are the prices on the inside quotes, the best available prices in the market. True value of a stock is either low or high. Some people know it, but the dealers don't. They're concerned about adverse selection. They know if the value is high, there will be informed buying. If the value is low, there will be informed selling. They originally have some beliefs, the dealers do, about the likelihood of high versus low. And so their initial assessment of the value of this stock is whatever the probability is of the value being low times what the stock's worth when it's low, plus the probability of what the stock being value being high times what the stock's worth when it's high. That's an expected value, that's an average value, given the dealer's initial assessments of the probabilities of the two states. So what should the ask and the bid price be? Well, the dealers need to condition on this adverse selection. They need to take that into account in advance, just like you do when you're bidding for contracts. So they ask, well, when does the ask price matter? It matters if there's a buy order that comes in that executes against it. And so when they compute that ask, they have to condition on that sort of selection. And so what they're going to compute is the probability of high, not initially, but conditional on selection. That is, conditional on there being a buy order that will hit the ask, that will execute against that ask quote. Similarly, on the bid, they have to condition on selling. And so we get a spread between the bid and the ask based on the different probabilities, conditional probabilities, conditioning on selection, conditioning on the type of order that arrives, and conditioning upon how much information there is, what the difference is between the low and high values. So this simple model supports, explains, helps you think about, and that's what a lot of our models in economics do. They help us think about the world. This helps us think about the liquidity of a market. Which markets are liquid? In which markets can you trade a lot? That's what liquidity means. And which markets are less liquid? As Traynor said, the liquidity of a market is inversely related to the flow of new information, meaning if there's lots of information out there, the market's not going to be very liquid. It's directly related to the volume of liquidity-motivated transactions. If lots of people are trading without information, the market will tend to be liquid. So we see those, if there's more new information coming out, if there are more people, more traders who know the value of the stock that the dealer doesn't, then trades are more informative. Trades are more informative. This conditioning is more important. The difference between these probabilities is larger. Adverse selection is worse. Conversely, if most people trading don't have information, then there won't be very much updating, there won't be very much conditioning, there won't be very much adverse selection, and the market will be very liquid. Now I want to talk about a recent phenomenon, fairly recent phenomenon. It'll lead us into a brief discussion of high-frequency trading. Again, this is an example of adverse selection, and it's something called penny jumping. So we have a market here that's at $49.96 bid. That's the best price on the orders to buy. And it's at $49.99 ask. There are 1,500 shares being offered for sale at a price of $49.99. Is there a good trading opportunity? Let me suggest one. Let's see how it works out. Suppose you put a bid in for 500 shares at $49.97. Now I'm going to argue two things. One, that that's probably a profitable trade without knowing anything else except the nature of this book and by the way, this book is public information, you can observe it, without knowing anything else except that the book looks like this, I would argue that this is probably a profitable trade. I'm also going to argue that it imposes additional adverse selection on whoever posted this 10,000 share order to buy. They already experience adverse selection that we went through, but that adverse selection is going to be made worse. So you post the order for 500 shares at $49.97, and suppose an order to sell comes in, executes against it, and so now you've bought 500 shares. Well, you didn't want this stock. You're just trying to make a profit. You're not going to hold the stock. You want to turn around and sell it. You're not a long-term investor here. You're just trying to make a market in the security and earn short-term profits. So when the bid is hit, try to sell now the 500 shares you just bought at a price of $49.98. If successful, you will have bought at $49.97 and sold at $49.98. That's what dealers do, right? They sell at one price, buy at another, buy low and sell high, hopefully. That's what security dealers do. That's what car dealers do. That's what dealers do in any market. They buy at one price and try to sell at another. Now, the reason that that's likely to be profitable is that one of two things can happen next. One is a buy order arrives, you sell the 500 shares and make your penny. Of course, sell orders could come in instead. If sell orders come in, though, what will happen? Will the market fall immediately? This is a pretty large order here for 10,000 shares. If sell orders come in, they're going to start eating up that 10,000 shares. Okay? They're going to cut into the 10,000 here that people are wanting to buy. If sell orders continue to come in and eat into that 10,000, you need to do something. It's looking unfavorable. What you can do is join them. Okay? You can turn around and sell. You can turn around and sell, so you bought at $49.97, you sold at $49.96. Now that's not typically a good thing to do. We like to buy low and sell high, right? And here you'd be buying high and selling low. But the key thing is that you can be patient. You can wait, because this is such a big order sitting here. You can be patient before you turn around and sell and lose the penny. Most likely, before that happens, some buy order will come in and hit you, and you'll make a penny. You have a greater likelihood of making a penny than you do of losing a penny. And the reason is that this is a large order sitting here, providing you an option to sell the 500 you bought, at most at a penny loss. It's providing protection to you. Now, what about the person who posted this large order? Are they happy that you stepped in front by a penny? No. If the market moves away, moves up, then they will have ended up buying 500 fewer shares because you stepped in front and bought 500. So they already experience adverse selection. All limit orders do, but you've increased the adverse selection. You've exacerbated the adverse selection on this large order. So what's the solution? Well, one solution is don't post 10,000 share orders, because people will take advantage of you. Some markets allow you to post large orders but not display them. The issue here is that this person has displayed an intention to buy. And by displaying their intention, they increase the adverse selection that they experience. By posting an order a penny ahead, you're essentially front-running. So don't display your intention. That's one solution. There are markets that allow you to post orders and only display a piece of it. So you could post an order to buy 10,000 shares, but only display 500, like an iceberg. Most of an iceberg is underwater. Okay, only a small part of it shows above. You can do the same with your orders. Another solution is something that markets have recently created, which are called dark pools, which are crossing networks for people who want to trade large quantities but don't want to display their intention to the marketplace. So these are all individually small, collectively now becoming important. Different arrangements, alternative trading systems, different arrangements allowing people to trade. This issue of stepping a penny ahead became possible, became more important at least, following decimalization. Prior to 2001, U.S. stock markets did not quote prices in pennies. We were still on a system of eighths and sixteenths. And a system of eighths is very different from a system of pennies, because then you can't, with a system of eighths, you have to step ahead by 12.5 cents. So your possible loss, if you have to turn around and sell to the large order beneath you, is 12.5 cents instead of a penny. The possibility of exacerbating adverse selection on large orders is much greater with penny pricing than with eighth or 16th pricing. Now, it used to be that there was a lot of depth in the book, large quantities posted in the book. Now, with decimalization, quantities in the book are small because you don't want to display your intentions. Now it's important to be fast, to see what's in the book and react, to see what's happening in other related markets and react. Now it's important to be fast because being first is not so useful since people can easily step ahead. There's something else now that causes markets to be fast, and that makes it important to be fast, and that's called Reg NMS, which was passed in 2007. That unified U.S. stock exchanges in the sense that the best quote in any market had to be executed before any other quote in any other market. It used to be you sent an order to one exchange, it would execute at the best price on that exchange. Now, if you send an order to an exchange and that exchange doesn't have the best price, there's some other exchange with a better price, the order has to be shifted to the other exchange, which makes good sense. But in order for that to be feasible, the SEC said that the exchanges themselves have to be fast. So you don't get this protection of having orders shipped to your exchange unless your exchange is fast. So this made, in particular, the New York Stock Exchange completely change the way it did business. So nothing happens on the floor of the New York Stock Exchange anymore. Everything happens in the computers because they have to be fast. Now, how important is fast? Some of you probably saw the 60 Minutes interview Sunday before last with Michael Lewis. Anyone see that? I know nobody watches 60 Minutes anymore. No one your age watches 60 Minutes. Right? There was a kind of nice interview on 60 Minutes with Michael Lewis, whose book came out a week ago. There was an article in the New York Times on Monday. There was an interesting op-ed piece in the Wall Street Journal last Tuesday about high-frequency trading. Okay? I'm just going to give you here show you some of the, how much it's important to be fast these days. Let me start with the bottom of this slide. This company, Spread Networks, in 2010, spent $300 million to build a fiber optics network between Chicago and New York. Now, there was already a fiber optics network between Chicago and New York. Why did they build a new one? Because they could figured out how to build it slightly straighter than the old one. So it's a little bit shorter. It's 3 milliseconds faster to send signals across the new fiber optic network as opposed to the old one. A millisecond is 1,000th of a second. So 3,000ths of a second was shaved off the communication time between Chicago and New York. They spent $300 million to do that, and then they leased time on this network to high-frequency traders who want to be fast. It's important to be fast. Fiber optics, not the fastest medium. Microwave dishes send things through the air instead of through cable. And it's faster to communicate through the air than through the cable. They shaved 3.8 milliseconds off the time between London and Frankfurt at a cost of 15 million euros. The new thing that's better than microwave is lasers. Shooting laser beams. Lasers have the same speed as microwaves, but they have higher bandwidth, so you can put more information in them. So laser networks have been built and are going up to shave communication time by millionths of a second between NYSE and NASDAQ. Trading firms also want to be close to the exchanges, so they pay millions of dollars a year to the exchanges for the privilege of putting their communications next, their computers next to the exchanges' computers. In fact, one company might have its computers against that wall and another company against that wall, and the exchanges' computers could be over here, and there's a difference in time, transmission time, between the computer on this wall and the computer on that wall. So what the exchange does is it coils up some wire so that there's the same amount of wire running between the exchange's servers and the computer on that wall as on the computer on the other wall. The 60 Minutes interview on Sunday, Michael Lewis's book is based upon conversations with a former trader who's now started an exchange. In their exchange, they have boxes with spools, and they coil up wire so they can delay the transmission time to the high-frequency traders. So they're trying to level the playing field by coiling up wire to make the transmission time longer for traders who would be otherwise closer. High-frequency trading is being investigated now by the CFTC, the SEC, the New York State Attorney General's Office, and the FBI. So it sounds horrible, but I would ask you to read the op-ed piece in Tuesday's Wall Street Journal, which was written by people at AQR Capital Management, which is a quantitative investment management firm, but is not a high-frequency trader, run by some PhDs from Chicago, who say they think high-frequency trading has actually cut their transactions costs. So they're in favor. These things seem clearly excessive, a waste of social resources, but it's not clear that the high-frequency traders are necessarily damaging to the markets. Okay, questions about that before I told you we're going to skip from topic to topic. And now, absent questions, I want to talk for a few minutes about signaling. So signaling is distinct from adverse selection, but closely related. If you remember, Michael Spence, one of the recipients of the Nobel Prize in 2001, his seminal paper was about signaling in labor markets. One of his examples explains the value of a college education. Part of the value of the education is it prepares you for the future. You learn things that are going to be useful to you in life, certainly. Part of the value is that it signals to employers that you're smart and hardworking. Right? Signaling is when an uninformed party, selection occurs when the uninformed party moves first. So I already described selection. Sorry, I should have put the definition of signaling up here while I was talking. Signaling occurs when an informed party moves first. So again, we're talking about differences in information between traders or between two parties to a contract, but the timing makes a difference. Now, a lot of situations are a combination of these two. It's hard to say exactly who's moving first, but it's helpful to try to isolate the two different phenomena. So an example of signaling is I would bet you that the change in my pocket adds up to less than $1. Now, I'm the informed party because I know how much change I have in my pocket, right? And I'm proposing the bet. I'll even give you good odds. I'll bet you $1 against 5. I'll pay you $5 if I'm wrong, you pay me $1 if I'm right. I'll bet you the change in my pocket adds up to less than $1. Any takers? What am I signaling to you? By my willingness to make this bet, I'm signaling, right? I'm signaling that the change in my pocket adds up to less than $1. There are two possibilities in signaling context. One, it depends upon the context. One is that all possible types of the party moving first, that is, someone with a lemon of a car, someone with a good car, all possible types do the same thing. That's called pooling. The other possibility is that different types do different things. That's called separating. Now we can infer the type from the action that the person makes. Now, there's a well-known signaling model of stock markets. I've talked about adverse selection. There's a well-known signaling model that a lot of my research has concerned. In the signaling model, the informed party, the trader, moves first, then the dealers respond. Okay? So a trader who is either informed about the value of the asset or knows he's uninformed, in any case he knows more than the dealer does, moves first, and then the dealers compete to fill the trade that the trader has asked them to take. So that's a little bit different from a limit order market. In limit order markets, orders walk up the book executing at different prices. In this signaling type of market, the whole order would be filled at the same price of what the value was given the signal. So one of my papers is related to this, a paper with Shmuel Baruch, who was a PhD student of mine, is now at the University of Utah. We looked at the difference between the signaling model and the adverse selection model and found that, in theory, equilibrium on a floor exchange involves pooling. Large traders pool with small traders by working their orders, that is, submitting orders in small pieces. And that is the phenomenon that we see in securities markets. And the two markets, in fact, should give you the same prices. Now, floor exchanges, as I said, have basically gone out of business, and the reason is that they're slow. So in theory, they offer the same prices, but in practice, they're slower than electronic limit order markets. So my message is that adverse selection is an important phenomenon in many contexts. It's important for pricing, and it's important for public policy. It's one of the things that economists think about. I think economists sometimes get a bad rap. I know many of you are in your Principles of Economics class, and you're probably thinking about whether to take more economics or not, whether to become an economist. I think economists sometimes get a bad rap, and part of it comes from the fact that they're asked to make quantitative forecasts, to forecast GDP growth, to forecast inflation. And those things are very difficult. Like forecasting the weather, they're inherently difficult. There's a famous quote from Harry Truman about economists that's a bit pejorative. Truman wanted a one-handed economist because all his economists, when he asked for an answer, they would say, well, on the one hand, but on the other hand. So he wanted economists who would give him definite advice. We're often unsure about quantitative forecasts, but I would argue that economists nevertheless have many valuable insights. On the subject of quotes, walking around your campus, I saw a sign. You have all these cute little signs posted in the grass along the walkways. I saw a sign that quotes Aristotle about politics. My theory is Aristotle didn't know about economics. And if he had, I don't know if you can even see this from the lecture, but if he had, he would have said that economics is the queen of sciences. Questions? Thank you. Oh, I'm sorry. There's.
Better be good.
Pressure's on now.
I'm just curious about the assumptions in the bidding example you gave.
Yeah.
You only talked about just price, but do any of these models take in other factors like previous relationships with other builders, or in the financial model, like previous relationships?
Yes.
With traders?
So there are many other things that you could gather information from to help you separate good types from bad types. And yes, they do take those into account. Thank you.
Thank you very much. We have a little memento here that we'd like to to give you and have you take away from Utah State University, but since we're sitting here in this room, which is the room where I took my first economics course many, many years ago, I remember my professor, Reed Durchie, talking about studying economics, said the study of economics won't make you rich, but at least you'll understand why you're standing in the unemployment line. And that may be true of studying economics, but I think you can tell, those of you who are taking careful notes today, that if you study finance, and I say this with due respect to my economics brethren and sisters, maybe you can get rich. So thank you very much, Dr. Beck. Great to have you here.